Hello and welcome to our discussion on financing decisions. We know that financing decision is a decision regarding the sources of finance. So financing decision reflects the composition of debt and equity on the balance sheet. And the composition of the debt and equity affects the cost of capital in the form of interest and the cost of the debt, cost of equity. But in this session we would like to answer this specific question. Is financing decision important or relevant for a regulated firm like a power distribution company? The answer is, of course, yes, financing decision is important. Why and how? Financing decision is important because it affects the annual revenue requirement of a power distribution company. The annual revenue required is used to determine the tariff or annual tariff, and ARR is equal to the cost of the fuel, employee cost, repairs and maintenance, depreciation, interest cost, and the return on equity. Now these two items, interest cost and return on equity, directly depends on the financing decision. So financing decision is important because interest and the return on equity depends on the financing decision, and interest and return on equity form an important component of annual revenue required. And a regulated firm or the regulator controls or regulates the ARR or tariff by regulating the return on equity and the rate and the interest to be allowed. So there is a concept called normative debt equity ratio, and how it different from the actual debt equity ratio. The actual debt equity ratio is one which the company uses for financing its assets. But the normative debt equity ratio is a ratio which the commission calculates or the regulator uses to calculate the annual revenue required. So the normative DER as of now in India is 70:30. That means the capital employed should be in the ratio of 70% debt and 30% equity. If the actual DER is less than, if the debt is more, then it's not a problem. But the cap is on the equity. If the actual equity is less than 30, then the actual will be taken. But if the actual equity is more than 30, then the normative equity will be taken for determination of ARR. So actual debt equity ratio may be completely different from the ratio which is used for computing the tariff or determination of tariff. Let us take an example to that effect. These two cases, case 1 and case 2, the assets are same. In the first case, the actual debt equity ratio is 0.17. In the second case, the actual debt equity ratio is 2.89. So the debt plus equity capital employed is 175,000. So if the actual DER would have been allowed by the commission, or this would have been an unregulated industry, then interest would have been charged at 12% on long-term debt, and suppose we say that return on equity, allowed rate of return is 17.5%, then equity would have received 17.5% return. But this is not the case. So in case 1, the debt plus equity is 175,000. If there would have been the concept of normative debt will be used, then debt DER should be 70 to 30 ratio. So the debt should have been 70%, 0.70, and equity should have been 0.30. So if you see here, the actual debt is only 25,000, but the debt which is taken for ARR calculation will be a normative debt, so therefore will be allowed is 0.12 into this, and on this it is 0.175. so the amount which will be included in the ARR will be 23,888 in the case 1. So the actual debt is 25,000, so the normative debt will be 125,500. Actual equity is 150. The normative equity will be 52,000. Now let us see the case 2. In case of case 2, we have the debt plus equity is same 170. The debt should have been 125, but you are using more, and the equity would have been 52,500, but you are using less. So in this case, the interest will be calculated on 130, and the equity will be calculated on 50.175 into 10 plus 32. So here we are going to take on the actual debt and actual equity, whereas in this case we are taking on a normative debt and a normative equity. We are taking on actual debt and actual equity because the equity is less than 30%. So therefore financing decision affects the power distribution company because of the ARR determination, and ARR determination depends on interest on return on equity. So therefore ARR is managed or regulated by regulating interest and return on equity through the debt equity ratio, and the regulated firm uses a concept called normative debt equity ratio, and the normative debt equity ratio is 70:30. So therefore debt equity ratio or financing decision is equally important for a power distribution company.